Hello and welcome to the 20th edition of this tax update series brought to you by Tax Essentials for Advisors. I'm your host Andy Rainford, Chartered Tax Advisor, Content Editor and, according to local folklore, King of the Karaoke Machine at the oldest pub in Wales. I have no recollection of this, so I am assuming it's just village gossip. In this episode, we're looking at the return of direct recovery, the latest news on advisor registration, and two very different cases where the appellants were in receipt of child benefit. HMRC has now recommenced the use of its direct recovery of debts powers, something we haven't seen actively used for some time. Just as a reminder, direct recovery of debts, or DRD, allows HMRC to recover unpaid tax directly from a taxpayer's bank or building society account without needing to go through the courts. Now, this isn't something that applies to small or disputed amounts. The power can only be used where the tax debt is at least £1,000, the debt is established and legally due, and crucially, the taxpayer has the means to pay but has repeatedly refused to do so. There are safeguards built into the process. HMRC must have made multiple attempts to contact the taxpayer. The debt must be final, so past appeal deadlines. And before any money is taken, officers are required to make a face-to-face visit to confirm the individual circumstances and explore alternatives, such as agreeing a time to pay arrangement. In addition, HMRC must leave a minimum level of funds in the account, currently £5,000 across accounts, to prevent genuine hardship. That said, this is still a significant enforcement power. The restart signals a more assertive approach to debt collection. For advisors, it's a reminder to ensure that clients with outstanding liabilities are engaging early and not ignoring correspondence. Once cases move into enforcement territory, options narrow quickly. Advisory fuel rates applying from 1st March 2026 have now been published. As a reminder, these rates are used where employers either reimburse employees for business mileage in company cars, or where employees reimburse the employer for private fuel used in a company car. If the employer reimburses at or below the advisory rate, there's no taxable benefit and no national insurance to account for. Go above the advisory rate, however, and the excess is treated as taxable earnings unless you can demonstrate that it genuinely reflects the actual cost per mile. Looking at the new rates, petrol and diesel remain unchanged. LPG rates have reduced slightly across all engine sizes, and for electric vehicles, the advisory rate for home charging remains 7 pence per mile, but the public charging rate has increased from 14 pence to 15 pence per mile, reflecting higher commercial charging costs. Employers can continue using the old rates for up to 1 month after 1st March, so there is a short transitional window. However, payroll and expense systems should now be reviewed and updated to ensure the correct rates are applied. And just to reiterate, if an employer reimburses above these advisory rates, they must be able to evidence that the higher figure reflects the true cost per mile. Without that evidence, the excess becomes taxable and subject to national insurance. Now, a quick update on the winter fuel payment and coding notices. The winter fuel payment was paid automatically at the end of 2025 unless pensioners opted out. However, where gross income exceeds £35,000, the full amount is clawed back. For those not in self-assessment, that recovery is made through the 2026-27 code, effectively spreading the repayment across the year at roughly £17 per month. Some 2026-27 codes have already been issued, and HMRC has confirmed they may not yet include this adjustment. There's no need to take action. Revised codes will be issued in April 2026. Finally, it's possible to opt out of receiving the winter fuel payment, but this must be done each year. An online opt-out form is expected from April 2026. HMRC has now published its first guidance on the new mandatory agent registration regime that starts from May 2026. Under the Finance Bill provisions, anyone who interacts with HMRC on behalf of another person's tax affairs and is paid to do so will need to be registered as a tax advisor before they can continue to act. The guidance confirms that registration opens on the 18th of May 2026. Advisors who already have an agent services account won't need to register again, but HMRC will contact them through that account to confirm they meet the new requirements. If you don't have an agent services account but do have a self-assessment or corporation tax online account, you can register from the 18th of May and must register by the 18th of August 2026. Those who only provide third-party payroll services must register by November 18th, 2026. Professional bodies have pointed out that the initial guidance lacks some key practical details, so advisors should read HMRC's guidance alongside the finance bill clauses and keep an eye out for further updates. Next, a useful reminder of how strictly the joint property income rules operate. Mrs. Odina jointly owned 3 rental properties with her former husband. Her tax returns showed adjusted net income over £50,000, including a 50% share of the rental profits. She received child benefit, but did not pay the high income child benefit charge. HMRC issued discovery assessments, and she appealed, arguing that she had never actually received the rental income. It had all been kept by the husband. The tribunal accepted her difficult personal circumstances, including findings of financial abuse, but that didn't change the tax position. Under the statutory rules, income from property held jointly by spouses is treated as arising 50-50 unless a valid Form 17 declaration is in place. No Form 17 had been filed, so despite non-receipt, she was taxable on 50% of the profits. Her income exceeded the threshold, and the charge applied. The key takeaway is that the joint ownership rule operates strictly. Actual receipt of income is not the deciding factor. And finally, a case on failure to notify liability. Coincidentally, this also related to the high income child benefit charge. Miss Zifi received child benefit in years when her income exceeded the threshold, but did not submit tax returns. HMRC issued discovery assessments and penalties on the basis that she had failed to notify liability under Section 7 of the Taxes Management Act, 1970. She argued that she had phoned the Child Benefit Office to explain that her income was over the limit, and that this should count as notification. The tribunal disagreed. While it accepted that Child Benefit Office staff could be officers of HMRC, it held that Section 7 requires notice in writing. An oral phone call does not satisfy the statutory requirement. As there was no written notification, the failure to notify stood, and the assessments and penalties were upheld. If notification is required, it must be in writing, and capable of being evidenced. Okay, that's it from me for this week. Thanks for watching.
Thanks, Andy. There really do seem to be plenty of people still slipping up with that child benefit charge. Now, our webinar on making tax digital took place this week, and it was packed with helpful information. You can view it on our YouTube channel at the link shown here. Stay tuned for a quick sneak peek.
Qualifying income, as long as they notify HMRC of the cessation, they're out.
Excellent. And I suppose on a related topic then, so if we're in a similar situation, but rather than ceasing, the client's downsized the trade or the property portfolio. So again, if we assume we've got income above the threshold in 24-25, but the income's dropped in the current year, 25-26, to say 25,000, is that enough to put off registration, or is it a case of tough?
This is one of the ones that catches everybody out. So that's a case of tough. You have to cease all of your qualifying income before mandation to be brought back out of MTD for it to not apply to you. So even in the case that you're, say that in a situation where your sole trade was £51,000 of turnover, you're mandated, and it dropped because, for example, and it doesn't really matter the reason, but to illustrate it, say you get sick or your partner gets sick and you need to look after them, and so your turnover absolutely tanks and you've got £2,000 a year. Because that was part of your qualifying income that's gone over the threshold, you still are mandated for MTD and would still be expected to keep digital records and submit quarterly updates and your final return under the MTD system. That is catching everyone out. A little bit extra on that is that the best way to think of this is in terms of what made up my qualifying income that is mandating me, because you can have the same sort of question when somebody starts a new trade before they're mandated. So say in that period